In this video, I'm going to discuss the latest addition to my dividend portfolio. It's an ETF that offers a dividend yield that exceeds 11% and it pays distributions monthly. But before getting into it, do your own research before considering this holding for your own portfolio. I'm going to mostly focus on the positives that this ETF offers, but I'll also touch on the potential downsides to keep in mind as well. This holding is primarily focused on high income and not so much growth, although I do think that's still likely with this position. The newest high-yielding dividend investment in my portfolio is ticker IYRI, the NEOS Real Estate High Income ETF. According to this fund's page, it says, IYRI invests in an underlying portfolio of US-listed REITs and implements a data-driven call option overlay that seeks high monthly income in addition to the dividends received from the underlying REIT allocations, which may offer investors a higher income complement or alternative to existing REIT allocations. On June 23rd, I bought 126 shares of IYRI at a price of $50.53 each. I already received my first dividend from this holding, which was for $58.75. Also, for the sake of transparency, this makes up roughly 2.7% of my overall dividend portfolio. In my opinion, there's a handful of really appealing features that this fund offers. As I previously mentioned, it pays monthly distributions and it offers a yield that exceeds 11%. It's pretty well diversified for being a sector-specific fund, as it currently holds over 70 different positions according to the NEOS website. I also don't think the expense ratio is too outrageous with this, as it's pretty much on par with other covered call funds and other NEOS funds. This is now also the third fund that I own by this company, with the others of course being SPY-I and QQQI. So the fact that the same company behind this fund is also behind my favorite monthly dividend ETF was one of the biggest motivators I had when deciding to pick up some shares of this fund. Buying this ETF did violate a rule that I generally like to follow when it comes to picking investments. I normally don't like to buy options-based ETFs that are less than 1 year old, as I generally like to observe how they'll perform. But as I'll explain later, the strategy behind this fund is really straightforward. This isn't that intricate of an investment like something that we'd see from Simplify or even some specific yield max investments. As you can tell from its description, IYRI is a real estate ETF, more specifically a real estate investment trust fund. If we look at its top holdings, we can see it's exposed to a lot of the most popular REITs in this sector. But to understand why it holds what it holds and the allocations for it, we need to look at the ETF that it's modeled after. IYRI uses its covered call strategy on IYR, which is the iShares Real Estate ETF. If we compare all of its top holdings, you'll see that they're all pretty much the same. The NEOS fund is just slightly different when it comes to allocations, which can be due to the iShares fund updating its holdings before NEOS does. Ticker IYR is an index fund that tracks the Dow Jones US Real Estate Capped Index, which is a newer index that was introduced in 2020. The index uses a capped methodology to limit the weight of the securities of any single issuer to a maximum of 10%. And although the vast majority of its holdings are equity REITs, it does hold 4 mortgage REITs, including Annaly Capital, AG&C, Starwood Property Trust, and also Rhythm Capital. I might as well answer a pretty common question that I get with these covered call ETFs. People will sometimes point out that I own several individual positions and then I'll go out and buy a covered call fund that holds those exact same positions. For example, I own Realty Income, Triple N REIT, Rhythm Capital, and a couple of others that are already inside of this NEOS ETF. If you're wondering if I think the redundancy and exposure to some of these companies is bad, I don't believe it is. I'm willing to hold funds with duplicate positions if the strategy they use is different. That's another way diversification can be used for your dividend portfolio. It's not just about the individual companies themselves, but what the strategy is of the ETF that holds them. According to IYRI's prospectus, it says, the fund is an actively managed ETF that seeks to achieve its investment objective by investing, under normal circumstances, at least 80% of its net assets plus borrowings for investment purposes in securities of real estate companies. The fund defines as those companies included in the Dow Jones US Real Estate Capped Index and utilizes a call option strategy to provide high monthly income, which primarily consists of writing call options on one or more ETFs that seeks to track the index. The fund seeks equity appreciation through its investments in real estate companies and seeks to generate high monthly income from the premiums earned from writing the call options as well as the dividends received from the fund's equity holdings. So to give a brief summary, this ETF uses a covered call strategy in a similar way that SPY and QQQI do. Only instead of owning what's in SPY or QQQ, it uses IYR, which are all index funds. Actually, according to its prospectus, I guess it could use a different Dow Jones US Real Estate Capped Index ETF if it wanted to, but I don't see any reason why they'd want to do that. Another feature is that all the dividends paid by these REITs inside of IYRI are part of the dividend payments every month. REITs are required to pay out most of their earnings in dividends, so these distributions, combined with NEOS's covered call strategy, give this ETF a really appealing yield. And the majority of REITs that exist pay quarterly dividends, whereas this fund is able to pay out monthly. Looking at its share price, it only has 7 months worth of a track record, but we can see that it's been flat since its IPO. If we were to compare that to VNQ, which is a Vanguard REIT index fund, it's also been mostly flat for the year. However, given IYRI's ultra-high dividend yield, it's currently beating VNQ, and it's up about 5.5% with dividends reinvested in 2025. Speaking of dividends, they've also been pretty stable with not much movement. This year has been pretty flat for the real estate sector in general, but these high dividends make up for the lackluster share price movements. If you were wondering, another reason why I decided to buy this fund now was partially in anticipation of interest rate cuts. I made a video 2 weeks ago where I talked about how REITs are going to benefit from interest rate cuts. These companies will be able to buy more properties and renovate their existing real estate more efficiently while saving a lot of money doing so. Refinancing will also become cheaper for these companies if they have any significant debt that needs to be taken care of. There's an inverse relationship that exists between REITs and interest rates. Again, because they have to pay out so much of their earnings to shareholders in dividends, they usually borrow a lot of money. So when we do get those rate cuts, then all REITs are going to save a good amount of money by doing what they normally do. Many companies in this sector haven't been able to fully recover even from what happened in 2020. Some did, but some other REITs came up short in 2022 when interest rates started going up. When all that started happening with interest rates, many investors started selling them off on the hunt for better short-term profits. But as I like to regularly remind people, the vast majority of REITs have been fine this entire time. A couple of these companies have cut their dividends in the past 3 years with 2 or 3 notable reductions, but most have continued to expand their portfolios, although a bit slower than before. If we do get 2 rate cuts this year, like the media's been predicting, that should generate a lot more interest in REITs. So that basically summarizes my motives for picking IYRI as another income holding for my portfolio. It comes with a high yield that pays monthly, it's well diversified for a REIT-specific fund, and the expense ratio isn't too bad. I'm also hoping that REITs do much better in the latter half of this year. But feel free to let me know your thoughts. Do you think IYRI is an attractive investment, or is there something better? Feel free to leave a comment below, but with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.